We think that active investing, carefully selected portfolios are going to be much better at capitalizing on AI infrastructure plays where those matter, domestic demand stimulus plays where those come into focus in Southeast Asia.
Hi, viewers. Welcome to Season 2 of Unscripted in conversation with Eastspring. What better way to start off than speaking to our chief economist for Prudential and Eastspring Investments, Ray Farris. Ray, great to have you on the show and to top it all off.
Thanks for having me, Salman.
Let's talk about macro and we'll dive into a couple of themes today with you. We started the year by arguing that both Asia and emerging markets would outperform the US. That's happened in spades. Look at Korea, look at Hong Kong, look at China. Though that comes naturally with increasing valuations, even on the fixed income side. We've seen the Singapore bond market outperform the US. So great call on that. But how are you thinking about increased valuations and where do we go from here, Ray?
Valuations are not cheap anymore. That was part of the story early in the year. However, on a relative basis, Asia is still dramatically cheaper than, for example, the US, which is close to historic valuations. Growth is going to continue through the region. Part of that's because China has committed itself to trying to grow 5% about 5% in 2026. A lot of it has to do with the boom in AI infrastructure, which is part of what drove positive surprise across the world. That's going to continue in the US. The pace will slow, but it's very strong support for exports out of North Asia and selected bits of Southeast Asia. Finally, there's a lot of fiscal stimulus and monetary stimulus that's coming through the region that will help to support domestic demand.
Now, what we did see, though, Ray, was a lot of the growth was on the back of Asia-led export. You and I've talked about the tariffs, the impacts, how they're biting through. How do you see that stalling any part of that growth and spoiling this narrative in terms of what we're seeing in the markets? How do you break that down?
Exports are going to slow. There's going to be some degree of bifurcation. North Asia will probably continue to do better than Southeast Asia for the simple reason there's a larger exposure to AI infrastructure, semiconductors and the like, in Korea, Taiwan, China. There's a little bit in some other bits of the region, Singapore, Malaysia. But governments are working to try to offset that. So Thailand, Indonesia have announced new fiscal stimulus programs. We expect more rate cuts in Thailand, in Indonesia, in the Philippines, in India. India's announced a string of fiscal stimulus that really is only just beginning this year and will kick in to a greater extent next year. What all that means is that for some countries in the region, the focus of growth is going to shift. It's going to go from being export-led to much more about domestic demand, and in some cases, domestic demand, asset inflation stories, property.
Now, on the back of that, we are as a house as well proponents of active investing. When you think of Asia from an asset allocation perspective or a capital allocation perspective, is it an index play or how do we think about that?
Well, look at the performance this year. If certainly indexes did okay. However, if you dig into that, tech has outperformed massively. In Southeast Asia, financials have done much better than the rest of the index. In Japan, performance has really been, very selective. So you can simply try the beta plays. However, we think that active investing, carefully selected portfolios are going to be much better at capitalizing on AI infrastructure plays where those matter, domestic demand stimulus plays where those come into focus in Southeast Asia.
And look, a key part of all of this macro drop is the US dollar. Just a very quick take from you on how do you see the US dollar faring from here and how should Asian investors be thinking about it?
We still think the dollar probably weakens next year. I think a lot of that's going to be, it's going to come down to basically the Fed being dovish, cutting interest rates even as inflation in the US goes up. So real interest rates come down relative to other countries. For example, it looks like the ECB is no longer going to cut. And I think the BOJ will hike. The key assumption in that is a dovish Fed. And I think for that to really materialize, we need to know who President Trump appoints to replace current Fed Chairman Jerome Powell. Our bias is to think that person is going to be dovish and is going to push the Trump agenda of a much lower interest rate structure and a weaker dollar.
Fantastic. Look, Rick, always great to have you on the show. Great to start off. I'm sure we're going to be catching up as we go along. But thank you, everyone. We're big proponents of active investing. So when you think of Eastspring, think Asia, think active. Very good to see you. Thanks for being here.
Thanks for having me.